don't have 120 and higher numbers. Now, this slideshow on psychology, I feel, is the most important in my part of the four slideshows we have made. So um, this could be very interesting in terms of investments. There's also a saying that that uh, mastering the market is easier. Mastering yourself is very tough. So that is what psychology is, and investments are, because without psychology there is indeed not a consistent profit. One can make some money sometime, one can make some profit sometime, but one can be lucky sometime. But in terms of creating a large wealth, generational wealth, you either need to have a rich parent, a rich grandfather, or you really need to have the mindset to be able to do it. Without the mindset, it's very hard to create wealth. And investing in stock markets are also about mindset. Investing in markets um, mm, is not very new, or not very different from creating a business or creating an enterprise or doing anything else. I think it is just that stock markets are get a lot of attention because from day one you can make some money, and that is why it seems that stock markets are easy. But stock markets are like any other enterprise. One needs to learn, one needs to experience. There is nothing which can actually substitute experience. And why experience is so important is because experience teaches us the character of the business and the psychology aspect of the business, whether we are suited for a certain business or a certain trade. Now there are very few surveys that are there, and where um, a person can actually find out whether what kind of holding period one should have, whether one is an investor or one is a speculator or one is a trader or one is an arbitrager. Now, these are the things which are very tough for somebody to understand, and there are very few books written on it where one can read it and understand that yes, the way my personality is, according to that personality, I am a day trader, or according to my personality, I should not be a day trader. Now, these are the things which have not been discussed. These are the things which are not being done. These are the kind of things which companies or intermediaries should educate or should explain the final client or the customer or the investor, which is not generally done, because not much academic research also has been done. I remember reading something about a PhD um, in psychology helping traders and brokers at a big US company handling stress. There is so much stress in stock market which also needs to be handled, and stress can also cause emotional problems. There's also a saying that high trading jobs after 35 years of age, or after a certain age, 45, you cannot really do high stress jobs. And as we age, our mindset changes. As we move in life, as we get married, our mindset changes. We are a different investor when we have a girlfriend, and we are another investor when we are married, and of course we are another investor when we have a child. So with age, the psychology of the mind changes, but psychology is given very less importance, and it is the most important in an investment um, process, in the investment technique. Um, when I took the survey, I think about 10 years back, I was going through investment psychology book, and I read the survey, and I thought I had a certain profile of investment, and when I went through the survey, I was kind of surprised that is this me? And then I thought about it, and I reviewed my thoughts, and I realized that yes, the survey was depicting my risk profile very well. Now, this is a kind of shock I had 10 years back. I will not be surprised if some of you actually take those surveys and realize that your holding period is different. You are a great investor, or you are a great trader, and this is what is somewhere how we are built, how we are, our risk taking abilities, our our risk handling abilities are are very much connected to the time that we hold an asset, whether we hold for some time, short time, large time. And it is also linked with how we are designed as human beings, as how our psychological makeup is. Now, how we are psychologically created also is linked with the kind of childhood that we had, the kind of time we had, the time we lived in. Somebody who lived in 1700s would have had a different psychological makeup because of the times of 1700. One who lives is born in 2000 has another kind of setup. So the culture around us, the time that we live in is has a lot of bearing on our psychology. Now, people who investors who may have been in the market for a long time and who saw a crisis for the first time have really taken a shaking in terms of psychology. Very few of the people who have taken large losses have the courage to come back. How we handle loss is also about is also about psychology. And they say that a married broker um, has a lower churn rate of a portfolio than an unmarried broker. Now, these are facts and statements written in books, and there is an excitement which an unmarried man has, and there's another kind of excitement which a married man has. So these are all different kind of type of classification of investors and brokers and analysts. All these are already written in books. So psychology, as I said, is very important. I My focus or my move towards investment psychology um, was linked with some of the few books I read, and of course, as a part of CMT, I had to read like a few psychological books, investment psychology books, and as the content started to change and the markets started to get more complex, the course curricula also changed, and I came in a time, or I studied in a time where behavioral finance uh, became um, very much visible. In 2002, Daniel Kahneman Daniel Kahneman, who was a psychologist, got a Nobel Prize in 2002, and he got the prize in economics. So he was the first psychologist to get an economics Nobel Prize. Now, this is very might sound very strange. Rather, when I read it, I found it very strange. How can a psychologist get a prize for economics? And but again, as I studied it more, it was of course very had a very large, very big aura on me. I was very impressed, and I when I was learning, technical analysis, 1998, and I was 1999. I went through some training yeah, courses, and the teacher there was mentioning that there is a new area of study which is called behavioral finance, and it complements technical analysis. It proves that the technical analysis is a science. Now 10 years down the line, I believe, and I when I read things, I realize um, that there is a this is not true, because behavioral finance, there is a there is like behavioral finance does not uh, encourage or does not believe in patterns, or it doesn't behavioral finance is not about patterns at all. So that is a big conflict for technical analysts or for people practicing charting. Now charting and behave and psychology is not connected in the subject, but again, for investor, a study of patterns and knowing your psychology are both very important. So these were some misconceptions as early as 10 years back, where subjects we talk about subjects, and we hear about subjects, and um, we we start believing is like something about subject, but the whole understanding really comes in when you go into it a bit deeper. Now there are so many books written about it, and rather the subject of behavioral finance started somewhere in 1950s. 1950s they started it, and it took about 50 years for the subject to reach an academic degree where it was accepted by mainline study. So this was the man who started um, the subject, and he wrote a paper in 1950s, and he was Herbert Simon, and he also got a Nobel Prize in 1978. And his paper was um about the economic man, and he was trying to make the model of thinking of the economic man. He was saying that in uh, uh, the explanation of economic man assumes that he is rational, and Herbert Simon said that no, this models need to be redefined, you know. And so this was the his first paper idea that he wrote, and which was a cornerstone paper where he said that the model needs to be redefined. But again, as the work got interpreted and his paper got interpreted, they there are a lot of people who came and started to work and study, and somewhere the idea of Herbert Simon was not taken in the full spirit. He was not saying the economic man was irrational, but he was saying that the rationality needs to be remodeled. But today, behavioral finance uh, is focused more on trying to illustrate that how the economic man is irrational, or how he's not rational, or how there are so many so many errors in his thinking. Somewhere the subject got a bit pushed towards an extreme, like as we humans do, because it was a great idea that to prove that after 150 after actually yeah after actually 250 years after Adam Smith, that economics was there was no economics without psychology, and that was a very large thought, and this gave the new thinkers, a lot of boost. So somewhere I this is my own opinion, that they exaggerated a bit with not a bit they exaggerated a lot with proving that the human beings were irrational.